Steve, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
Janine, this podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve, today's first topic is the Canadian real estate market's navigation through interest rate adjustments and mixed sector performance in 2024. According to the Morguard Canadian Economic Outlook and Market Fundamentals, 26th Annual Edition, the Bank of Canada accelerated its interest rate cutting cycle in the fourth quarter, responding to weaker than anticipated economic performance. The policy rate stood at 3.25% at the end of 2024, following significant cuts in October and December.
Janine? That's right, Steve. It seems like the real estate sector showed resilience despite the economic challenges. While some sectors performed better than others, the overall market managed to hold its ground. The lower interest rates were intended to stimulate consumer spending and residential investment, which is always good news for potential home buyers.
Steve. Indeed, Janine. The report anticipates increases in housing sales, home renovation spending, and business investment. However, it's also important to note that while the Consumer Price Index rose by 2.0% year over year in October, the high cost of food continued to be a challenge with prices from stores rising significantly.
Janine? Yes. And while shelter costs rose, mortgage interest costs saw a more modest increase, and rental prices increased by 7.7% in November. Looking ahead, the report suggests consumer price growth might increase with the implementation of U.S. tariffs, which could complicate things for Canadian consumers.
Steve, the S&P/TSX Composite Index also posted a modest gain in the fourth quarter, capping off a strong year with an 18.0% return for 2024. It's interesting to see how different sectors, like information technology, outperformed with a 2024 return of 32.5%, while real estate only gained 1.7% for the year.
Janine, and when we look at investment market activity in Canada's commercial real estate sector, it remained moderate. There was a decrease in total transaction volume, but interestingly, office sector investment sales rose significantly. It's a mixed bag, but there's still confidence in several sectors, especially industrial properties.
Steve, absolutely, Janine. The industrial property sales increased, and even though the retail property investment market remained subdued, there's a focus on value creation in existing portfolios. It's all about strategic investments right now.
Janine, inflation's jumped to 2.6% year over year in February, which is quite a leap from January's 1.9%. This rise is more than economists had anticipated. The main drivers of this surge were higher costs for recreation, education, and reading, which increased by 3.4%, along with clothing and footwear and alcoholic beverages, tobacco, and recreational cannabis seeing notable price hikes.
Steve, right, Janine. And it seems the end of the GST and HST break on February 15th played a significant role in pushing these prices up. According to Statistics Canada, the expiry of this tax break exerted considerable upward pressure on prices for eligible products like restaurant meals and certain retail goods.
Janine, it's interesting to see how some areas like gasoline actually saw weaker price growth, which helped temper the overall rise in the Consumer Price Index. Gasoline prices grew by 5.1% year over year, down from 8.6% in January. Shelter costs and transportation expenses also showed slower gains, with only slight month-over-month increases.
Steve, yes, and mortgage interest costs rose by just 0.2% for the second month in a row, which slowed the annual growth to 9%. This marks the end of a long stretch of double-digit increases, spanning about 2.5 years. On a month-to-month basis, the Consumer Price Index rose by 1.1%, with a seasonally adjusted increase of 0.7%.
Janine, the core inflation measures that the Bank of Canada closely monitors also point to similar trends. The Consumer Price Index, excluding food and energy, rose by 2.9% year over year, with a seasonally adjusted monthly increase of 0.5%. The bank's preferred measures, CPI trim and CPI median, also climbed to 2.9% year over year, the highest level for CPI median since October 2024.
Steve, with these inflation figures, the Bank of Canada finds itself in a tricky situation as it considers an April rate cut. According to TD Economics' Leslie Preston, Canadians' inflation expectations have risen, while tariffs and uncertainty are already impacting economic activity. BMO's Benjamin Reitzes suggests that the latest data will reinforce the bank's cautious approach to easing rates to mitigate the impact of tariffs.
Janine, it's a complex picture, Steve. Reitzes also pointed out that the end of the carbon tax and the ongoing reversal of the GST and HST holiday could further complicate the inflation outlook. There's still a lot of uncertainty about how tariffs will play out, and markets have already reacted to the CPI data, with Canadian bond yields rising 6 basis points after the release.
Steve, absolutely, Janine. Preston expects the Bank of Canada to provide some cushioning with 2 more 25 basis point rate cuts in the next 2 announcements. Although markets have slightly lowered their odds of a cut on April 16th due to the inflation numbers, there are still many unknowns regarding tariffs that could influence the decision. Steve, recently we've seen a significant shift in global investment patterns, with foreign investors pulling out of United States stocks and pouring billions into Canadian bonds. In January 2025, Canada experienced a major inflow of foreign capital, largely driven by bond investments as global investors reacted to U.S. trade policies.
Janine, that's a fascinating development, Steve. It's interesting to see how economic uncertainties and trade tensions in the U.S. are influencing investment behaviors. According to Statistics Canada, foreign investors purchased $7.9 billion in Canadian securities, marking the highest monthly bond investment since April 2020. This shows a strong confidence in the Canadian market, especially in the bond sector.
Steve, absolutely, Janine. This increased appetite for Canadian bonds can be partly attributed to the U.S., tariffs, and the economic uncertainty. Investors have poured $33.5 billion into Canadian bonds, with a significant portion, more than half, going into U.S. dollar-denominated debt. Provincial government bonds were the biggest beneficiaries, seeing a record $10.8 billion in foreign purchases.
Janine, it's also worth noting that Canadian investors are pulling back from foreign holdings. They sold off $3.2 billion, mostly in U.S. equities. It seems there's a shift towards safer investments, given the volatility in U.S. markets and the ongoing trade tensions.
Steve, exactly, Janine. Canadian investors offloaded U.S. stocks at the fastest pace since March 2022, selling $15.6 billion worth in January alone. Instead, they opted for foreign debt, purchasing $14.4 billion in bonds. This includes $6.7 billion in U.S. bonds and $8.4 billion from other countries, resulting in a net inflow of $11.1 billion into the Canadian economy.
Janine, the Bank of Canada's decision to cut its policy rate to 3.0% likely made Canadian bonds more attractive. Additionally, the Canadian dollar's depreciation by 0.7% against the U.S. dollar added to their appeal. Despite a 3.3% rise in the S&P/TSX Composite Index, foreign investors reduced their holdings in Canadian stocks by $6.6 billion. It seems investors are prioritizing safer, long-term debt over equities.
Steve, that's right, Janine. This reduction was mainly due to merger and acquisition-related retirements and secondary market sales. The focus is clearly on safer investments, particularly long-term debt, as investors navigate the current economic landscape?
Janine, it's a complex situation, but it's evident that both foreign and Canadian investors are seeking stability amid global uncertainties. The shift towards bonds reflects a cautious approach, emphasizing the importance of strategic investment decisions in these times.
Steve, First National has reported a remarkable 44% increase in funded single-family residential mortgages in the fourth quarter. This is a significant jump from the previous year and indicates a strong performance in the residential sector.
Janine, that's quite impressive, Steve. It's interesting to see how First National has managed to achieve this growth despite the competitive market landscape. The focus on residential mortgages shows the ongoing demand for housing and the resilience of the Canadian market.
Steve, absolutely, Janine. The total mortgage originations, which include commercial deals, were up by 26.5% year over year, reaching $2.1 billion. While this growth is commendable, it's important to note that much of the additional funding came through securitization. This means the revenue from these originations will be deferred and realized over time rather than immediately boosting earnings.
Janine, that's an important point, Steve. It shows that while the immediate financial impact might not be visible, First National is setting itself up for stable, long-term growth. Securitization allows them to manage risk effectively, which is particularly crucial given the economic uncertainties.
Steve, Jason Ellis, the president and CEO, highlighted the year-over-year growth in residential funding during the fourth quarter, especially after Scotiabank re-entered the market. Despite the normalization of market dynamics, First National remained focused and achieved a 44% increase in single-family originations compared to 2023.
Janine, yes, and with the wave of pandemic-era mortgages coming up for renewal, First National is poised for a significant earnings boost. These renewals are particularly profitable since they do not incur broker commissions, and the company earns a new placement fee with the same institutional investors.
Steve. That's a strategic advantage, Janine. CFO Robert Inglis referred to these renewals as real gravy for the company. They provide a stable revenue stream without the associated risks, as all funding and interest rate exposure are borne by the investors.
Janine, it's reassuring to know that despite some challenges, like the rise in arrears in the Excalibur portfolio, First National's exposure to credit losses remains minimal. The company lends primarily in well-established markets with strong liquidity, which helps mitigate potential risks.
Steve. Exactly, Janine. Even though the Excalibur portfolio saw arrears rise, the early 2025 trends are encouraging, with delinquencies starting to decline. This suggests a beginning of the end for elevated arrears in this segment.
Janine, it's clear that First National is navigating the current economic landscape with a focus on stability and strategic growth. Their approach to renewals and securitization seems well suited to weather the ongoing market challenges.
Steve. Let's dive into a recent case that highlights the importance of maintaining integrity in the mortgage industry. The Financial Services Regulatory Authority of Ontario has taken action against a former mortgage agent, Yujun Shi, who was involved in a significant fraud scheme.
Janine, it's truly unfortunate, Steve. Shi was hit with a $145,000 penalty for arranging fraudulent mortgage transactions and brokering loans outside of her registered brokerage. This case underlines the need for vigilance and adherence to regulations within the industry.
Steve, absolutely, Janine. She brokered at least 10 mortgage transactions outside her brokerage between January and June 2021, generating over $9 million in mortgage proceeds. The Financial Services Regulatory Authority found that 9 of these transactions involved fraudulent borrowers.
Janine, the details are quite concerning. Shi accepted illegal compensation and was part of a scheme where imposters posed as homeowners to secure fraudulent loans. This not only undermines trust in the industry, but also causes financial harm to lenders and title insurers.
Steve, FSRA emphasized that Shi's actions deprived clients of the consumer protections provided under Ontario's mortgage laws. They noted red flags in her transactions, such as her failure to meet borrowers in person and the wiring of funds to multiple bank accounts in China.
Janine. It's a reminder that mortgage professionals have a responsibility to prevent fraud and ensure they aren't enabling criminal activity, whether knowingly or unknowingly. This case is linked to a broader scheme involving other industry professionals, which highlights the systemic risks.
Steve. Indeed, Janine. Another former mortgage agent, Lin Liang, was fined $440,000 for brokering fraudulent loans totaling $17.9 million. These schemes damage the integrity of the industry and lead to increased costs for everyone, including lenders and consumers.
Janine. It's disheartening to see such breaches of trust, but it's crucial that regulatory bodies take swift action to protect the industry and the consumers. Despite title insurers covering many of the fraudulent claims, some lenders still faced significant financial losses.
Steve, the Financial Services Regulatory Authority of Ontario's actions serve as a stern reminder of the consequences of engaging in fraudulent activities. It's vital for mortgage professionals to uphold ethical standards and protect the integrity of the industry.
Janine, absolutely, Steve. As we wrap up today's episode, it's clear that maintaining transparency and accountability is key in the mortgage industry. Let's continue to advocate for ethical practices and support measures that safeguard consumers and lenders alike.
Steve, thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Janine, before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.